Okay, students, where we left off, we were doing our various adjusting entries for the end of the month, and I started to talk about interest and said I wanted to come back to it. So it's time to come back to it. So let's talk about what interest is. So one of the things that we have already been working on is recording notes payable. Right, so if I walk into a bank to borrow $20,000, I'm going to make a journal entry that is a debit to cash for $20,000 and a credit to notes payable for $20,000. Now remember, the difference between accounts payable and notes payable is the time involved and some of the legalities around it. A note payable is usually very formal. There's usually a legal agreement and there's a stated interest rate. Okay, so the stated interest rate is important to us as accountants because we need to account for that. But let's talk for 1 second about what is interest. So if you were going to loan me $10,000 today and I told you I'd pay you back in 6 months, you would probably want me to pay you back more than $10,000, right? Because that money, instead of earning, interest in your bank or being invested in the stock market, you lent it to me. So interest is a way that we compensate each other when we borrow money. Right. I'm filming this right now in 2020. Interest rates are abnormally low, partially due to where we are in the economic cycle, partially due to the pandemic. But borrowing money is relatively inexpensive from an interest rate perspective. But let's just pretend for a second, let's just use a rate of 5%, right? So let's say I have a loan for $20,000 and I did it at 5%. Most important thing I want you to remember, because this confuses students all the time, so stick with me here. I'm going to put it in all caps. The interest rate is always an annual rate. Okay, now what I mean by that is that anytime we write down what the interest rate is, that's how much interest we would earn if the loan were for 12 months. But the loan could be for 3 months, it could be for 6 months, it could be for 10 years. But 5% is how much it would earn if it were an annual note, okay? And we do that just to keep consistency. That way it makes it easy to compare things. So if this loan were outstanding for a year, the way we would do the math is we would take the principal, we would multiply it times the interest rate, and that gives us 1 year interest. Now, obviously, if we're not going to have this for 1 year, we may have to go ahead and turn that into a percentage. So for example, what I always do next is I divide it by 12. So now I have a 1 month interest. Then if the note is 3 months or 6 months, I simply take that 1 month interest times the length of the note, or length of time. Okay, so let's make this more real. So let's just say I borrowed $20,000 for 3 months at a 5% rate. Okay, first step, how much is that interest per year? So I'm going to take the $20,000, which is the principal, times 0.05, because that's our rate, right? So to turn it from 5% into something we can use in a mathematical equation, we put as 0.0. So obviously if this were 10%, I'd have 0.10, right? Okay, so $20,000 times 5%, that says, y'all know I cannot do math when I'm in the middle of a lecture, but I believe that is $1,000. I better just do that math, even though I know it's so simple. I know. I just get nervous when I'm lecturing and I can't do it right. Yes, it's $1,000. Okay, so if I borrowed that $20,000 at 5% for 1 year, I would owe $1,000 in interest. But what if instead I've just borrowed it for 3 months? Well, the easiest thing I can do is divide that annual number by 12, because we have 12 months in the year, and that would tell me that I'm roughly needing to pay $83.33 per month. And if my loan is outstanding 3 months, I multiply that number by 3, and that says that I would owe $250, right? So hopefully what you're taking away from this is that interest rates are always annual. To turn them into monthly, I multiply the principal times the rate and then divide that answer by 12. And then I multiply it by the number of months I care about. Now, oftentimes in these notes, we don't pay that interest monthly. And so one of the things we've been talking about is the fact that even though we don't pay it, doesn't mean it does not exist. Let me say that differently. Just because I don't pay it, it still exists, right? It is still there. I still have to pay them eventually, and I need to record an expense. So when we do our adjusting entries, we need to look at our borrowings and say, do we owe any interest? So in this example, we've borrowed $10,000 at 12% interest, okay? Looks like we borrowed that money December 1st. We're now at December 31st, and we need to make an adjusting entry, even though we won't pay it until next year, okay? December 1st of next year. So how much interest have I incurred between December 1st and December 31st? I'm going to take the $10,000. Right, let me use my pen here. I'm going to take the $10,000, multiply it times the interest rate, right? So on your calculator, you would use 0.12. And then I'm dividing it by 112. Now that's just a shortcut. Like me, I like to way oversimplify it. So I always divide by 12 and then multiply by the number of months, whether it be 1 month or multiple months. 1/12 makes exactly the same sense, right? So, all right, so that leads to us knowing that between December 1st and December 31st, we've incurred $100 worth of interest expense that we will not pay until next year. So I need to record that by debiting interest expense and crediting interest payable. All right, we'll go through more interest things in class. All right. The next example is around accrued revenue for services. This works exactly like if a customer buys something on account, right? They're just using some fancier words here. They're just saying we haven't billed them yet. We've done some services but haven't billed them. And I can see that scenario, right? So let's contrast it, even though it ends up with the same entry. If I said to you, you have a customer that purchased something on account, usually what that means is they walked in the store, they bought your item or they used your service, and they walked out and said, I'll pay you back later, right? In that case, we debit accounts receivable, credit service revenue. What could also happen is maybe we're in the service business, we're in a lawn care business, right? And so we've been out, we've been cutting lawns all month, and we've cut $700 worth of lawns, but we haven't sent the bills to those customers. I'm going to end up with the exact same journal entry. Okay, so I just want you to think of it as it's the exact same. It's just kind of how it happens. Is it somebody walking out with my product or my service telling me they'll pay me back later? Or is my business model that I do work for customers and I bill them in the future? Okay, so let's pretend in this example that I have been mowing lawns and I have mowed $700 worth of lawns by the end of the year that I have not yet billed my customers. I still need to record it. Why? Because I've earned it. Remember, the most important thing isn't whether or not I've been paid. The most important thing is whether I've earned it. So I did the service. I'm going to send them a bill. I debit accounts receivable. I credit service revenue because I want the readers of my financial statements to know I did that service. I earned that income. So that's pretty straightforward. So that's the end of the different types of adjusting entries that we're going to be doing in Chapter 3, and we'll keep working through them in class. But what do we do after we've done these adjusting entries? So remember, let's go back to our cycle, the beginning, right? We did transactions for the period in Chapter 2. This chapter we've been doing end of period adjustments. And now it is finally time to do the financial statements, right? So I need to, in between finishing my end of period adjustments and my financial statements, I have to post those adjustments, right? That just means update the balances, put together a new trial balance, right? Because obviously, since I made more journal entries, I've got more balances that I need to update. I need to check again. Did debits equal credits? They do. Great. Okay, I'm finally here. I'm finally ready to put those financial statements together. So if you look at your adjusted trial balance, they've color coded it here for you, right? Green are things that are going to go to your balance sheet, right? And including some of this red down here, because eventually your common stock and retained earnings end up on your balance sheet as well. And blue is income statement. Now, what do we start with? We start with the income statement because we need that net income number. So we're going to go from this trial balance to the income statement. So let's just take a look and so I can prove to you how this works. On my adjusted trial balance, I have service revenue of $7,200. When I come to my income statement, I have service revenue of $7,200. If we look back at that trial balance for rent expense of $500, yep, we would see rent expense of $500. So all you're doing is just dropping in your numbers to create your financial statement. Now we know our net income is $1,200, right? We don't see that net income number anywhere on the trial balance because it's just accounts. It's account balances, right? We're doing math on the income statement and providing that net income number. We've done that, so now it's time for our statement of stockholders' equity. You'll have to have some additional information for that, such as the problems will tell you if you've issued common stock, right? Paid dividends. And we plug in that net income number, the $1,200 that we just calculated back here on the income statement. That gives us an updated retained earnings number of $1,000, common stock of $25,000. Where are those going to go? Those are going to go onto the balance sheet. Here on the balance sheet, you can see there's that common stock of $25,000 and retained earnings of $1,000. Everything else on the balance sheet, your assets and your liabilities, again, are coming straight off that trial balance. Let's do a double check. Cash of $6,900, is that what's on the trial balance? Cash of $6,900. Yes, it is. So as long as you get everything from your trial balance over to your income statement and your balance sheet should balance, right? If it doesn't, it probably means you've got an account from your trial balance you've put in the wrong place. Usually when students make this mistake, they've accidentally put deferred revenue on their income statement. Remember, deferred revenue is a liability that I owe somebody, or they put accumulated depreciation on their income statement. As I talked about in the last video, accumulated depreciation represents how much our equipment has decreased in value, right? It's a contra asset account. Okay, so now we've done all of our financial statements. I'm not putting the cash flow up here because I don't make you guys do it. And we're wiping our hands. We're going home and celebrating. We did it. We got through the month. We got our financial statements out. And that's good news from the accountants. But we have one more thing we have to do. And we usually do it actually the next day when we come in to start the new month or the new year. And what we have to do is close out everything. So after I have issued my financial statements, I'm going to go through this process that is called the closing process. And I want you to think of it simply as a reset, right? Because we've talked about the fact, let me go back here, that the balance sheet is permanent. If I end December 31st with $6,500 in cash, I will come in on January 1st with $6,500 in cash. If I owed $900 in liabilities December 31st, when I walk in the door January 1st, unless I've paid some bills overnight, I still have that liability. So I want you to think of the balance sheet as permanent. Contrast that with the income statement. The income statement, poof, starts fresh, January 1st. January 1st, I'm back to zero on my income statement because income statements are over intervals of time. They aren't permanent. I've reported to my shareholders what I earned in the previous year. Now we're starting a new year. So I need to get all of those accounts on my general ledger back to zero. So I need to take every single account that's on the income statement and make a journal entry to put it back to zero. Now, in the real world, the computers do this for us. We get through our financial statement process, we hit a button and say, reset for next year. But in this class, you'll actually make the journal entries yourself. And they're straightforward. Remember how when we put together our statement of stockholders' equity, we had penciled in the net income and the dividends to calculate how much retained earnings should be before we put it on the balance sheet? Now we're going to actually make journal entries into retained earnings for those net income items, which are revenues and expenses, and for the dividends account. So those journal entries are simply coming in and zeroing the account out. If I had $7,200 in service revenue, right? Service revenue is a credit balance. To get it to zero, I will debit it, and I'll balance the entry with retained earnings. For each of my expense accounts, rent expense, supplies expense, etc., I'm going to zero them out by putting credits into the account and debiting retained earnings. So remember, we had reported $500 in rent expense for the previous year. Now it's the new year, we're zeroing that out, putting it into retained earnings. And we do the same thing for dividends. So if we look up here at the retained earnings T account, right, this was a new company, which is why it was zero at the beginning. We've increased retained earnings for $7,200. That was the revenue. We've decreased it by $6,000. Those were the expenses. And decreased it by $200. That was the dividends. Now our general ledger balance of $1,000 actually matches what was on the balance sheet that we reported. After we do this, we usually run one more trial balance and just make sure. Okay, so when you're doing these problems, because when you get to your next project, project 2, you're going to do all of these yourself and connect. Look at that trial balance, that post-closing trial balance. Make sure you don't have any revenues or expenses on here. You should have just zeroed them all out and gotten that retained earnings to match your balance sheet. All right, that's what we do. That's the end of chapter 3. At this point, we're ready to start fresh in theory for the new year, right? Accountants are usually exhausted after they've gone through all of these processes. But that takes us from the start of the month, making our journal entries. Let's go back and look at that picture one last time, right? Opening balances, right? We've got our opening balances. We do our transactions. We do our end of period adjustments, issue our financial statements, and then close down everything. And then poof, start again the next day. All right, that's it for chapter 3, students. Hope you enjoyed it, and I'll see you in class.